All right. Again, thank you all very much for joining us for today's webinar. We'll cover some performance highlights from 2019. We'll touch on QwickAnalytics, and we'll spend the majority of today's call just introducing you to IntelliCredit. My name is Sean O'Brien, the president of QwickRate. As you all know, I've also done a couple of other things where I continue to serve on a board of directors from the National Bank of St. Anne, and then I helped found QwickAnalytics, and I'm very excited to introduce today, for many of you, David Ruffin. David joined our team last year, late last summer. David has done a number of, as you can see, a number of different things. The bottom line is he's an experienced credit professional, and we are delighted to have David join us today. He'll come on the call here in a little bit. I'm going to take you through the performance highlights, touch on QwickAnalytics, and then we'll come back to David, and he'll take us through the end of the presentation. As all of you know, we are in listen-only mode in GoToMeeting, which means you can hear us. When we can't hear you, you can certainly ask questions. We'll take those at the end of the call today, if there are any. We will also send you a recording of today's presentation along with the slide deck. So we'll circle back with those probably early next week once we get the recording and have those available to you. As we touched on, QwickAnalytics, it's been developed from a number of different viewpoints. We think viewpoints matter. We started this really back in 2012 with just a very single UBPR summary. We've expanded to where we are today. We're very proud of that. But it's really been formulated by viewpoints from not only us as through QwickRate and our years of working with banks, but it's also formulated by my role as a small community bank director. The challenges that we face are often the same that you're facing, so we try to build tools that we think can save you time and help your bank manage the bank more effectively. And then it's also been formulated by our sister company, Monroe Financial Partners, who has done a lot of the analysis. They make markets in community bank stocks, and as a result of that, and their partners manage a fund called Santa Capital, a $350 million fund that that invests in community bank stocks. There's 25 to 30 years of experience of looking at bank performance and information. Has really allowed us to build QwickAnalytics where it is today. I understand some people are having trouble hearing me, so hopefully I've tried to fix the phone here, and hopefully all of you will be able to hear me better now. As we do every quarter, we kind of look at the community bank sector. We call it the QwickAnalytics Community Bank Index. You'll often hear us refer to it as the QCBI. It was really an analysis of community banks that's formulated by the FDIC study in 2012 about what is the definition of a community bank. We think that's important. Obviously the FDIC puts out a lot of information, but these numbers are also always represent what's really happening with the biggest banks. And so we always want to kind of take a little bit of a deeper dive and see what's happening just within the community bank sector. So that's why we've created this QCBI structure that you'll see us and hear us reference in QwickAnalytics. You can see the breakdown of banks. We continue to lose banks, or continue to lose banks in 2019. You can see the breakdown of the banks by size, how they're owned and structured. Again, this trend doesn't seem to be slowing. Hopefully, we can at least continue to do everything we can to keep community banks surviving and thriving. Asset growth was pretty good in the last 12 months. A really pretty big pop-up. This, was kind of realized by banks of all sizes. Obviously, the 1 to 10 billion banks saw the biggest growth by asset size. The smaller banks grew, but not quite nearly as fast. The loan story is a little bit different. Obviously, a lot of cash was coming into the banks, not being quite deployed as quickly as it has been over the last 4 or 5 years. Again, the loan growth was, realized by banks of all sizes, but again, the smallest of the banks having, the most difficult time generating loan growth. You can see here on this slide just loan to deposit by region. Again, interesting, the Northeast maintains a very high loan-to-deposit ratio. A lot of mutuals up in the Northeast, and so a lot of home loan lending. I suspect that's a big driver of their higher than everyone else's loan-to-deposit ratio, but a good steady increase for the most part. Dipped a little bit here and kind of flattening out, but really strong. Just loan-to-deposits. Assets are being utilized within the banking sector. Deposit growth, we saw some really strong deposit growth here in the last 12 months. Again, it has come at a little bit of a cost for a lot of banks, but again, realized by institutions of all sizes. This has resulted in a lot of banks requiring less wholesale funding. Again, there's just there's always a kind of certain threshold that banks use for wholesale funding, but with the rise in the strong loan to deposit, a lot of times you'd expect that to be driven by more wholesale funding, but this time it's we're not necessarily seeing that, right? It's been pretty steady and even dropping here and rounding off here in the last 12 months. Performance numbers, again, you don't want to say everything's about as good as it gets, but everything's about as good as it gets, right? While the cost of funds have gone up pretty precipitously in the last 12 months, we were, for most of the industry, able to pass along some of those in the form of higher yields on loans. At the median, these are all median numbers. You can see NIM, remained really strong despite this increase in the cost of funds, and even the efficiency ratio has held steady over the last 12 months. As I mentioned, banks were really able to defend their NIM in 2019. And keep it almost relatively flat despite the large uptick in the cost of funds. I suspect we'll see some moderation in the funding cost this year, but hopefully that will not correspond with a decrease in the yields that banks have been able to receive on the loans. The efficiency ratio, breaking it down a little bit deeper, you can see a little bit of an uptick in the Northeast for the efficiency ratio in addition to the West, but again, all pretty solid efficiency ratios for banks across the country. As I mentioned, profitability numbers, have been really pretty good, right? And you can see back still the impact of the tax cuts, really supported really very strong bank earnings, and again, across the board, even by asset size, the smallest banks have the lowest ROA, but everybody else has been able to realize a pretty strong ROA and accordingly then a very strong ROE. So credit costs have been relatively benign. So again, all in all, it's pretty good days for the industry. Interestingly, in 2019. Community banks were more valuable than the larger banks. If you look at these, this is M&A data that we have available in QwickAnalytics, but you can see the price of transactions and targeted banks here in 29, and both on a last 12 months earnings price to earnings and a price to tangible book value and even tangible book to core deposits. You can see the premiums there. Everything's stronger for banks under $1 billion. So that's certainly it's heartening to see, it's encouraging to see, and I think, again, goes along with the theme that we have, which, again, is there's always going to be a market and a need for strong community banks, and oftentimes the tales of our demise are often exaggerated. So, again, 2019, a very, very strong year for banks, in terms of being targeted institutions. On the asset quality side, again, the non-performers have continued to come down. Loan loss reserves have held pretty steady. Charge-offs a small uptick, but again, everything a pretty good picture. You see that again here with the total non-performing loans to loans across the country. Again, all telling a fairly strong story, and again, fairly decently reserved. Again, this will be interesting to watch. It's interesting that the Northeast continues to have the lowest reserve despite having the highest loan-to-deposit ratio. Again, it speaks to a lot of just having an understanding with your examiners on where they feel their comfort level is with the reserve to loans. But it'll be interesting to see this year with the SEC filers starting their CECL transition and conversion, what happens to reserve balances as the larger banks start to make the first foray into CECL. Again, reserved to non-performers, again, holding strong and pretty steady. Finally, capital within the industry remains strong. Again, I think it'll be interesting to note how many banks just opt into the new capital ratios, or if some want to run a little bit leaner, they'll not opt in. But again, within the industry, very strong capital levels, and again, always kind of, the first line of defense should we ever, come into any kind of hiccup. At QwickAnalytics, we were busy in 2019. As you can see here, we made a number of enhancements that we're very proud of, and again, just continue to try to continuously improve our products so that our users, again, can find everything they want, but we're trying to be responsive to requests for information or tools as best we can. I've highlighted here, QwickBonds. We developed a bond comparison tool. A lot of you may not be aware that as a QuickRate subscriber or a QwickAnalytics subscriber, you already have access to this. And what it allows you to do is to check the price on any bond. So, we're not suggesting that you have to use us to buy or sell bonds, but if you are receiving a bid or a bond of the day or something where you're being shown a bond to buy, you can simply come into QuickRate, click on the QwickBonds tool. I'll show you here in a second. Enter the QSIP, and it'll give you 5 bonds that are similar, and you're able to check to make sure your pricing is appropriate. So again, we just think every basis point matters, and having the ability to go out and check this very easily, we think, is again another tool that our subscribers will like. And I'll come back to that here in a second. In addition, we added public company and stock market information. So for the banks that have ticker symbols, we've added additional functionality and information around their pricing. We've included SEC filings, any company reported financials. Again, trying to provide any publicly available information to incorporate that into QwickAnalytics and make it available to our subscribers. We also were very excited to announce this year we added the Excel add-in tool. Again, this is a feature that you can download, and once you do, you get a QwickAnalytics choice on your toolbar, and then from there you have the ability to import any piece of call report information that we have in QwickAnalytics into your own spreadsheet, whether that's on your bank or other banks. If you want to do bank research, it just provides you with the ultimate tool and flexibility for call reporting information. Again, we've always tried to organize information in a way that we think is helpful, but again, if you want to look at something specific or we haven't formatted or templated something in the way you want, you can simply import that information into your own spreadsheet. We've also here just in the last month or so added additional M&A data. As all of you may or may not know, we had historical M&A data available in QwickAnalytics. This just again in the last month or so, we put out additional deal valuation and deal data to all the deals. So not only can you see the target and the buyer, you can get valuation numbers about the target. So again, we think again just another example of us trying to continuously improve the information that we are providing to you. A big enhancement in 2019 was improving our CECL solver. We released that. It does satisfy the regulatory expectations for CECL. We continue to make improvements on that, and in addition, as David will touch on later, we'll be able to even further dive into that with IntelliCredit if that's something that our users are interested in. We use a combination of the weighted average remaining maturity method, the WARM method as it's often referred to, and a snapshot open pool. This just gives you an example of the summary results. Again, where we kind of take call report level information and compare this to your current reserve, so you can kind of do a side-by-side basis. As we move towards implementation, in order to make sure everybody in the bank, your regulators, your auditors, are all on the same page. But this again was all derived from guidance provided by the FDIC in a number of the webinars they've done over the last couple of years, and we're very comfortable and confident that, for most community banks with a fairly traditional loan portfolio, this not only will get you to the finish line, but again, will be an acceptable way for you to produce CECL on an ongoing basis. As we all know, we gained another year, so 2022 is now 2023. So we've got some more time, but again, we've designed ours to make it an easy way to transition and run them on a side-by-side basis as we work towards the implementation date in 2023. Besides that, we do think, besides the fact that ours is a call report level, or excuse me, a portfolio level CECL solution, we do think you should be capturing data on an ongoing basis so you have it in the future should you need to pivot, or if it's in your best interest to pivot. So we do recommend capturing a lot of data. We'll provide you with this interagency loan data request. Again, it's a list of fields that we think users should, or banks should be using and have available. Again, if the regulator were to ask or their auditor to ask them to do something more on a loan level basis for CECL or a stress test, we can help you and assist with you if you provide us with this type of loan level information. So just before we go out here and jump into QwickAnalytics just for a few minutes, why we designed this and what we're doing, we really think it's a great research tool for banks to use to, to continue to survive and thrive. Our value proposition is very simple. We create tools so you don't have to. We do the heavy lifting, and again, we think and we've spent a lot of time trying to put them in formats that we think are useful and easy to utilize. We want to take you out of the aggregation business and put you into the analysis business. So that's, we spend a lot of time trying to do that, but as I mentioned, if we didn't do it right, then that's why we have the add-in tool for you to use. One of the reasons why we think peer data and this type of information is available within QwickAnalytics is, while no one likes filling out the call report, it does give you the ability to comment size, and comment sizing is the best way to compare banks of all sizes. And so our little bank in St. Anne, we can compare to JP Morgan, and despite the fact we have nothing in common, we both fill out the same call report, and we can compare ourselves on a side-by-side basis. So that can be a fairly powerful thing as you find more meaningful peers, whether it's in your local community, whether it's in your state, your UBPR peer group, or just your business line, just to see how you compare to banks of similar characteristics. I'm going to jump out here to the interactive pages now. As I mentioned, this is a continually improving site. We do have available, assistance available for, whether it's just implementing QwickAnalytics or any of the tools that you'll see here. So again, we just want you to know we've designed it to be a do-it-yourself, but we're always available for you should you need assistance. So as I mentioned, when you log into QuickRate, there's a QwickAnalytics tool. Here you can see the bond comparison tool that I want. Let's see, hopefully if I'm still logged in, if I can type in a QSIP, I can demonstrate this for you. But you can just simply type in a QSIP. Oops, I got to log back in. There, you knew it. I knew it was going to happen. Should have checked. Okay, so if you go to the QwickBonds tab, you can type in any QSIP that you have. So again, if you're being shown a bond, you can type that in there and hit the search key. And what it'll do is it'll compare your bond. So here's a Federal National Mortgage Association agency bond. Here's the yield to worst. When you put that QSIP in, you can see there's similar bonds with a better yield to worst. So these would be better bonds to potentially buy. The one thing about the bond market is there's not much transparency in it. That's what we're really trying to do is to highlight, if the bond you're being shown, if there's a comparable bond that might be better, that really, contains the same characteristics of the bond you're looking at, but just may offer you a better price. As I mentioned, every basis point matters. And so it's as simple as that. Again, you can always contact our trade desk, Matthew Coe. Can assist you if you want to learn more about QwickBonds, but it's just another tool that we have available. So within the QwickAnalytics tab, when you log in, we're just on a sample bank. We've added more regulatory data. We've added, as you can see down here, information on publicly traded companies, the M&A deal multiples that we touched on and showed an example of, all available here. The Excel add-in research tool is available to be downloaded from here. And so again, just a number of the same reports that we have, including our 3 different peer reports. We have a Reg F snapshot so you can do your Reg F due diligence. We provide a portfolio level credit stress test, a capital planning tool. There's our CECL solution, and we do offer you a liquidity risk report as well. We do give you a number of different ways to do additional research should you like. But for a lot of our banks, they simply want to kind of come in and see what's going on with their bank. And so by clicking on your bank's name, it will take you to your interactive pages. And then what we've done is, you can see here, we've organized call report information into ways that we hopefully you find very helpful. We organize your top deposit market branches by taking the summary of deposit data every year from the FDIC. And then, as you can see here on the overview page, we put call report information in a way that you can see absolute performance over time. So we'll always show you at least 4 to 6 years of historical information. And then here to the right, you can make peer comparisons. You can create as many peer groups as you would like with your with our custom peer group creator. And then once you have those, in addition to the UBPR peer group that we default you with, we give you your state peer group, and then you can change those out and you can see those informations updated here in a number of different ways. We give you the ability to look at different periods, and you can change the presentation from annual to quarterly. So that's true in all the pages that we have, and then in the peer numbers, we show you a median and then where your bank ranks within that peer group. So again, really just trying to give you the tools that you can do the analysis and not all the aggregation. As I mentioned, we give you a number of different ways to kind of look and drill down on your performance, as they're all listed here. And then you'll see in 2020 we'll be expanding this with a greater emphasis on credit due to the addition of David Ruffin and the IntelliCredit team. We're going to expand out our sections on credit and asset quality. So we've got a number of things in store for this year to continuously improve this website. We do have holding company information as well, and then as I mentioned, you can access the reports that we saw on the home page here as well. So it gets just a number of different ways to find out information about your bank, and then simply up here in the toolbar, you can begin to type the bank or the name of any bank in the country, and they'll show up. And if they don't show up, you can simply click the search button. It'll show you everything that has home as part of the bank's name in the country. And then you can see that bank or any bank in the country templated, their information templated in the same manner as you see here today. For the holding companies, again, that have ticker symbols, you can see those this year, but we have all the holding company information available to you as well. All right, so at this point, I'm going to turn it over to David Ruffin. So if you'll bear with me one second, I'm going to make David the presenter, and David's going to introduce you to IntelliCredit and just give you a little bit of a introductory presentation on what it is. We'll be hosting a couple of more detailed webinars in IntelliCredit in March, but we thought we'd use today just to give you a slight or short introduction into IntelliCredit. So I'm going to make David the presenter, and hopefully David will be able to take the screen and show it to you. There we go.
Okay, thank you so much, Sean. I wanted to first of all begin to say how excited for the IntelliCredit team here in Raleigh is to be associated with QwickAnalytics. We just see this as such a complementary and fantastic added dimension to everything that Sean just showed you. And some of you joined a November kind of rollout that we announced the formation of IntelliCredit. But there are 3 things I'd like to do today, just kind of tell you where we are with that. Number 2, just touch a little bit on where the credit environment is today. And just in conclusion, show you a little bit of where the IntelliCredit Portal is from a development standpoint, because we're real excited on all of these fronts. Again, much of what we had talked about in forming IntelliCredit really was about taking you to the future of probing the future and not just chronicling the past. It really is a tie in many ways to tie transactional credit risk. Particularly, you'll see that in work to aggregate portfolio performance. It really is very push button and real-time efficiency, almost revolutionary, particularly as it relates to loan review work. And I think it's important as anything because we all know it's a matter of time we get back in a little more stressed credit. It does allow you in the end to script your own credit risk profile. Nobody ever wants the regulators to come in and have to do that for them. Specifically, we are already off and running. We've got 3 external loan review engagements under our belt and negotiating a 4th. And we have designed this loan review component of the IntelliCredit Portal for not just external loan review, as is often vendor backed, but also for banks, excuse me, that are looking at it to adopt for their own internal loan review purposes. I was at the ABA, speaking to the ABA National Community Bank Conference just this week with Sean, and we actually had a potential prospect that says they've got internal loan review. They want to enhance their procedures. Specifically, just give me a moment to just talk about where the credit environment is. You know, I've been a credit guy virtually all my banking career. We had almost a 30-year consultancy developed around credit, all things credit for community financial institutions. And I completely agree with Sean. You know, some people even laughingly say, why are we worried about credit? It's about as good as it gets. That's true, but we also know that, you know, cycles come to an end, right, at some level. We've had a roller coaster aspect in the last 12 months, both in rate area and in growth on loans. Again, Sean somewhat alluded to that. But we've also got, I think, vigilance is the word that we have to call the flavor of the day, if you will. Vigilance, we're not doomsdays. I can't imagine us having the credit problems we had 10 years ago because there's not enough speculative lending in the pipeline. But we have to be vigilant. Again, long in the current cycle, we know business and credit cycles ultimately end or in some ways deteriorate, and I think it will be a premium to those financial institutions that begin to recognize deterioration, that there is a correlation between early recognition and some degree of loss or the amount of loss that you do incur. From a regulatory standpoint, their top concerns, and I say this from my perspective, not officially from theirs, but kind of an aggregation of what I've heard from them over the last year or so, is they're concerned about buildup in concentrations. They're concerned about loosening of loan structures to chase growth. And they're looking at something we certainly do validate clearly in our loan review, and that is the degree of adequate underwriting not being necessarily met with good post-booking analysis or annual reviews. And again, that is something we're seeing in our own loan review work, and I know that the regulators seem to be concerned about that. They're also concerned about the efficacy of the current credit review systems as it relates to issues in this. The third point there is the FFEIC interagency guidance on improving risk systems. It came out in mid-fall for commentary, and we're anticipating some final announcement of that, which basically just says, be sure your risk systems are adequate and are up to date relative to things like loan, particularly loan review and other aspects of understanding emerging risk. Just before Christmas, the FDIC issued a directive on higher concerns for CRE and leveraged loans as well. Again, I alluded to this a moment ago. One of the lessons we absolutely learned out of the financial crisis is 2 things. Vintages matter, and vintages mean that effectively, unfortunately, loans made late in the credit cycle almost always present the highest degree of toxicity for a lot of reasons, but they just do. Also, the cost of holding on to emerging credit problems can be very, very costly, particularly to smaller financial institutions. Empirical evidence, we've been involved in over 350 due diligences, M&A, or credit capital recaps over the last 10 years, and we've seen a lot of bond pool data emerge from that. And again, empirical proof that holding on to problems once they emerge almost inevitably correlates to higher losses. So we focus a lot on emerging risk. A lot of that we think is in low pass, what's going on in your past or low pass credits. Remember that none of that gets to the call report or public data. How are you handling exceptions? Tracking exceptions, profiling exceptions can begin to present to you as bank management some degree of potential emerging risk. And also, how are you tracking structure, loan structure, and covenants, and so forth? All of that is to say we are just so delighted in terms of our interface with QwickAnalytics, and again, think in many, many ways we can continue to enhance everything that Sean has just shown you. What I'd like to do right now, if I could, is just give you a sense of what we're talking about. We call it the IntelliCredit Portal, and largely the IntelliCredit Portal is a combination of the Portfolio Analyzer, which we'll demonstrate a good bit, and also Loan Review. And it's basically a subscription service where, again, the focus of IntelliCredit is understanding what is going on idiosyncratically within your financial institution that is not necessarily publicly known. And how we get at that, of course, is flat file data, information on your portfolio, and to give you somewhat of a heads up on emerging risk before it gets to that point. For example, and probably the heart of this can be just depicted in this graph here. This happens to be risk grade migration or indication of risk grades on the FFEIC codes. Of course, this is a bank's anonymized data, but showing the disbursement of grades in the various categories. I think the real issue for us in IntelliCredit is you notice from one year or one period to the next, the bell curve down at the bottom has migrated a bit to the right, which in effect says credit quality of this institution may be showing some signs of degradation. But you also notice that these are in the past loan category. Remember that published data, call report data and whatnot, it's all focused on non-pass loans. So if you totally are dependent on waiting until it gets to that level of public disclosure, some of this may be too late. And good credit people listening in today understand this, I know, in their sleep. But I think this needs to be hopefully a way to be quantified and a way to be efficiently looked at. For example, in this particular bank, I can also take a look at C&I loans, which is 4A. That even has a more pronounced move to the right, which means a more pronounced concern of potential degradation of credit quality. Other measures that we would be looking at would be things like concentration reports, which is very, very important in the regulatory sensitivity these days. I can look, as I say, on exception rates for commercial construction. Click on that, and this is one of the critical advantages you get to IntelliCredit and the IntelliCredit Portal is that we not only provide a lot of aggregate portfolio data, but we have the capacity to drill down. In this particular case, we're looking at the loans that comprise that 18% of exceptions, and we can drill down onto that. We also can look at other measures that might be of some interest to you. We look at pricing for risk. There's an example here. We're all used to kind of heat map depictions of what's going on in our portfolio. This is an example of where there's some logic embedded in our portfolios where we're actually accruing on a yield basis less risk grade 3 than a risk grade 4. And again, the drill down would be applicable for those. We have a vintage analysis where we can go in and look at, this is, as I indicated, 2019 loans. Obviously, that's where most of the loans new originations are for this particular bank, but I'm noticing here a blip up in our greater than 30-day past dues. Look into that category. Again, it brings up the specific loans at push button phase to determine, okay, what makes up that aggregate performance. We also have what embedded in this, which we found extremely helpful to people in credit administrations, credit officers, risk officers, and what have you, the ability to kind of look in or query the portfolios. For example, I'm going to start here. Let's take a look at what loans in our portfolio are 50,000 or greater that have a weak pass kind of cohort to it. And what we would do is we would look at the 50,000 greater than. We can add a group that basically has risk grade cohort, and see if I can find that, which we do, and then we will have that equal to, I think we said, a weak pass, and in terms of its categorization, should be able to spell a little better. Sorry. And let's see if that query will run. There you go. There are the loans that comprise 50,000 or greater that are categorized as weak pass. Another potential use of the pivot charts or pivot tables we can do just almost push button is, let's say I want to look at my interest rate dispersion over the last period. And we would say the data set needs to go in. I'm going to do a multi-select very quickly here, not to burn too much time, interest rates, and then I need to do this by exposure. And I believe on something that, yep, let me apply that. So we look at a natural interest rate disbursement across the portfolio, right? But I happen to, and this would be an example of using this for just QC purposes. Let's go to the latest month's data set. And what we notice here is what is a big blip up in loans on the books at accruing at 2% or less. Naturally, I'm going to want to look at that. And it immediately brings up, and this is frankly reflective of a real circumstance that occurred, a $4 million loan that has been booked erroneously at 0.4% as opposed to 4%. So naturally, this is a use of this tool, hopefully for even QC purposes, as well as obviously building reports, report types, or again, customized reports that you might want to do. I'm going to skip loan review for just a second because we'll go back to that in a moment. But this also has embedded in it a loan forecaster, which is basically a tool by which we compute your probabilities of default, your loss given defaults, which are critically important in doing one of 3 or 4 things, and that it informs it could well inform CECL information and enhance your ability to do a more accurate CECL. It also has the ability to inform a credit mark. It can do stress. It helps inform a stress test. And for publicly traded companies, what's now called a notional pricing exit, it is required of you to put in as a footnote in your financial statements quarterly. It gives you some basis for valuing that as well. Again, this would be a part of the portfolio analyzer. Again, very much specific to your bank in ways that would not necessarily be public data. What we have found that we're so excited about is the efficiency about the analyzer and the loan review. And just the risk of being a little gimmicky here, I will just say that we use video conferencing quite a bit. We encourage people to do that and say hello to everybody. I hope they can see that. but we have that embedded in there. We also have what is called real-time clearing of exceptions, which has been a remarkable revolution in our loan review work. Our loan review work is, and we're going to pivot now a little bit to the loan review component of that. Again, we built Portfolio Analyzer not to just do loan review as a traditional vendor service, but also to supplement banks' internal loan reviews if that's what they prefer to do it as. But in terms of what we're doing with external loan review, some additional measures we have here, we would be able to post continuous reporting of what loans have been reviewed in your portfolio in the last 18 months through an independent process, what loans have been subject to annual review or not in the last 18 months or whatever other categorization or chronology would do. And also, not unlike the risk grade distribution or migration chart I showed you a few moments ago, relative to the pre and post loan review, it can give you depictions of where risk grades are migrated. But as we show you just a little bit of what we do with the loan review process, we of course have the traditional individual reports that takes you all the way down to the individual credit that's been reviewed. We certainly have, again, deep details on risk grade migrations. But I think the most interesting insights we have or developments we've made on this to make this rather revolutionary is in the exception clearing process. This, again, is a summary. We kind of divide exceptions in three bases. Again, regulators seem to be extremely focused on exception tracking as, frankly, a forerunner of emerging problems. And they like, frankly, I agree, that the heightened exceptions is often a forerunner of problems or exacerbated problems once we get into a little more stressed credit. We separate those in legal docs, credit exceptions, and loan policy exceptions. And this is the example of a real-time clearing, which we like to think of as real revolutionary. We track on a constant basis what exceptions are made. These obviously are documentation errors, as you can see, title policy ensuring the new deed of trust record and reflecting. There was an issue of that missing. What we can do is have updates, comments made. You can upload the title policy immediately in here into the system. It can be looked at by a reviewer either internally or externally from a review standpoint, and those exceptions are clear. Obviously, I can't show you a loan review in place today, but I will say to the chief credit officer told us just 2 days ago this was the most remarkably efficient process he had ever seen in loan review. The fact that his team could go in and out of this electronically and clear exceptions as quickly. You know, the old system was you would print out, you'd have a phone conversation or conference call, you'd have debates around that, then you'd send in bulk examples of where somebody had to send a whole ton or stack of exceptions out. So again, we'd like to think this would be super effective. Again, loan policy exceptions, one of the growing issues of the regulators of wanting to quantify loan policy exceptions and to see if they're being mitigated. They documented that mitigation. Same convention applies here, listing of policy exceptions, and then an ability for the bank to document its mitigation. Again, not to belabor your demo aspect of this, I just wanted to show you progress we've made. Some of you may have been on the call in November, and that was, frankly, probably a rather boring just stack of PowerPoint slides about what our intentions were and what our dreams were around building this. But this has all been done even since November, and we're just as excited as we can be. And I hope, again, that, I'll go back to this risk grade distribution. In many ways, this tells the story of what IntelliCredit's all about, and that is everything that Sean told you about all the analytics associated with your published data and your capacity to pick your peer groups and look at how the investor and regulatory and the outside world receives your bank. We just see the IntelliCredit as an ability to add that further deep dimension on that internal performance that is not published yet, and in effect, frankly, is the heart of risk management in these so-called pass lines. So all aspects of IntelliCredit is frankly centered on how this risk is emerging, how it's being documented, how you're managing that within the bank. And again, we're not here to doomsday one iota. It's just a matter of, I think, vigilance is the word of the day. We do understand at some point in time we will have a little more stress credit than what clearly seems to be the case at this point, and I think this would be seen as an investment to fend off your problems when those begin to arise. So, Sean, I think I will be glad to hand this back to you, and hopefully this has been
Thank you, David. I'm going to take back the screen here. All right. So, hopefully everybody could see. I mean, again, as David mentioned, we are delighted and very excited about what David and his team, means to both QwickAnalytics and starting up this division called IntelliCredit. Again, we think it is a tremendous addition to what QwickAnalytics does, as David mentioned, right? A lot of the things that we see in QwickAnalytics is obviously post. It's call report information and the insight into your portfolio about emerging risk trends that IntelliCredit will be able to provide. We think is really not only a great complement, but just something that will be certainly helpful for every bank. Quickly, I apologize for the background noise. I'm sure that's coming from. But we do have 2 IntelliCredit webinars set up on the calendar for March 25th and 26th. So you can sign up for those now. Certainly in the interim, if you'd like to learn more about IntelliCredit, if you'd be interested in joining one of our CECL user groups or learn more about the portfolio analyzer or loan review, certainly contact David. His email's up here on the screen, or you can contact him by phone. And as I mentioned, we'll send out the slide deck and a recording to today's call later this week or early next week. And I'm going to have this presented to you. I forgot to do that. And then secondly, again, thank you very much for attending today. And, if you're interested in learning more about QwickAnalytics, you can sign up for a free 90-day trial. You can schedule a walkthrough, and we'll take you through your bank's information and discuss your bank situation. And you can reach out to us, at the email, or certainly give us a call, and we'd be certainly happy to help. All right, with that, I'll see if there's any questions. All right, I think if you have any questions, let them know. Right now there's not any, so we'll leave this screen up, and we'll thank you all very much for joining us today, and we'll look forward to speaking to you again soon, or certainly jumping on a webinar and talking to you about any of the services that QwickAnalytics and IntelliCredit can offer. So thanks again, as always, for your time today, and thanks for working with us at QwickRate. Have a great day.